The National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo special video event. March Madness, the Final Four Insurance Product in Review, broadcasting live from the All-American Sports Grill in Fountain Hills, Arizona, and sponsored by Legal and General America. And now, insurance columnist and talk show host, Steve Savant.
Well, welcome everyone to our annual March Madness tribute, the Final Four Insurance Product Review. We're broadcasting live out of Fountain Hills, Arizona, home of America's largest fountain, right at the All-American Sports Grill, one of my favorite places to lunch. And with me today, the Princess of Premium herself, the gal of the grids, Jessica Lopez. Hey, Jessie.
Hey there. Thanks for that introduction. You're phenomenal, Mr. Savant.
Well, I have to say, we have a pile we're going to be giving away on our landing page, the patented 2012 Term Insurance Report. This is our annual report. It's a take no prisoners review. We do a whole expose. It's all about commodities on a grid, I have to say. And the spreadsheets are to die for. And our sponsor for the report is the famous Ebix company, the people that do Vital Term. So you're going to really enjoy this report like I did. Let's get into it, Jessie. We have so much. Before, I want to set the ground rules.
Yes.
Okay? Now, I don't want anybody complaining I didn't put any banks in here. And the reason I didn't put any banks in because the channels sometimes are closed and we don't all have access to the products. And actually, only one bank really made the cut anyways. That was going to be decent. The second one is anybody that has a closed-in brokerage channel that doesn't give distribution to independents also didn't make my grid. Now, there'll be a little howling about that, I'm sure, but I'm trying to do what I can do for all our producers to have access to 95 to 98% of the market.
Absolutely.
Number three, carriers who really did win and rule the spreadsheets and grids, but they don't underwrite. Let me give you an example of what I mean by that. When I'm looking at the number 1 and 2 positions in every area, whether it's super preferred, preferred plus, preferred, standard plus, or standard, I really love the numbers. They fall on the grids at the top position, but I can never get super preferred. If I can't get super preferred, how worth it is the grid? Yeah, it's not. So those guys I had to toss because time and again they've proven, not only in our broker channel, but all the major independent marketing organizations, that these guys cannot underwrite at the high preferred levels. They're only advertising. They're not actually placing these cases. So sorry about that, but that's the way it is. Well, Jessie, let's get into it. We're going to talk a little about and touch on the term section, and let's start, male 45?
45, yeah, we're going to go ahead and concentrate on the age of 45, female, male right now. Again, with our term insurance report, you're going to have access to multiple ages, and of course you can contact us here at Brokers Alliance to speak to your life marketer in order to get details on any clients that you're working with. We're going to go ahead and take a look at female first of all, Steve, age 45. We'll start with the ladies. And looking at our 10-year term, Banner and ING are at the top. They kill it. We're looking at Banner Life, 10-year term, $525. ING, $528.
This is on $1 million, right?
This is on $1 million, and this is female. This is at super preferred non-smoker.
But by the way, a little side note, have you noticed that the female 10-year rates at age 25 super preferred, the policy fee is greater than the annual premium? I mean, how ridiculous is that? And remember, a lot of our carriers don't even pay compensation on the policy fee. So, man, I mean, we need to start bumping the minimum maybe from 100 to 250 just to make the annual premium greater than the policy fee. Go ahead.
Absolutely. Looking at a 15-year term, American General basically takes the top, $674. Again, this is all at $1 million, age 45 for females. And then we have, of course, Banner Life shows up again, $675. Looking at a 20-year term, Banner again at the top. They are just rocking the house here.
And by the way, a little side note, our sponsor, LGA, that's the new name for Banner and William Penn in the United States. So their parent company actually gave them their moniker now in the U.S., LGA, or Legal and General America. So when you see Banner, it's really LGA, and I think probably by the end of the year, that may all transfer to LGA.
I think it's all going to convert over. Absolutely, absolutely. Now looking at a 20-year term, we have Protective now at the top. Some of you may know them as West Coast Life.
I'm shocked, actually. Honestly, they weren't players, but all of a sudden their reconfiguration on their term, these guys are major players, and I got to say, major comp.
And phenomenal service.
Oh, yeah.
Fantastic service. Their annual premium comes out at $914, and we're looking at AXA, who comes up next, just $1 off, $915. So as you can see, we've done our homework here. We just want to give you the best of the best.
We're mercenaries. We don't care who wins. We have access to almost everybody that really matters in the United States. And I just want to point out, surprise there, wow, a big behemoth like AXA playing deep in the term area. That's huge.
Now, looking at a 30-year term, we have, guess who is on top again, Steve? Take a wild stab at it.
I would say LGA.
Yeah, there you go. They're on top, looking at $1,455, again, $4 million, 45 female. Now, after them, Genworth, phenomenal company. They have a great product, and also their policy fee is commissionable. So just a little side note there, and they're actually at the same premium as Banner in this situation.
That's a great point out, because a lot of people say, hey, look, not only is Genworth one of the top players on the grids, but they actually play on the policy fee.
Absolutely.
Okay, carry on.
All right, so now we're going to go ahead and take a look at the gentleman. $1 million again, male, age 45, 10-year term, Banner on top, LGA. $585, then we get into principal at $605. Going to the 15-year term, we have a Banner again at the top, $875, and American General, who comes up close at $884. American General has really stepped up as well. Their service is phenomenal. Just want to throw that out there. They also have easy access. All of these carriers, easy access on our website. Most of them do have iGo applications that are available, easy digital process. And so you know too, we're also having a raffle currently at Brokers Alliance. Anytime you submit an iGo application, your name goes into the bucket and you have the potential to win $500. So sorry, Steve, just wanted to throw that in there really quick.
I thank you for that iGo commercial. I hope they're going to pay us for that.
Absolutely.
And by the way, a little side note, AG, as you mentioned, AG not only is a player in our service area and they're showing up on the grids, but they pay. Right. So they're another compensation carrier that we really appreciate.
Great point. Looking at the 20-year term, Banner Life again on top at $1,155, and then principal coming in just $10 more. Looking at the 30-year term, we're looking at Banner Life at $1,885, and then we have Genworth, who is $1,890. So neck and neck, and they are both phenomenal carriers.
Wow, when I think about this, we're talking 30-year term, and there's not that many players in 40-year, but think about it. We're already out on 40-year level term. I've lived to see the day. My 30-year career, we went from, 20 was a stretch.
Right.
Now we're double that in the year 2012.
All right, fantastic. Now we're going to go ahead and skip into the non-cigarette smoker land. And what that means basically is we're looking at rate classes that are available to those who may chew tobacco, occasional cigar smokers,
snuff,
some snuff,
chew.
That kind of stuff.
I mean, I'm in a sports bar too, okay.
So we thought that that's important because there are definitely carriers out there that do stand apart, stand aside from everybody else. And I just have to say Prudential and John Hancock really are at the top in a majority of the options that we're looking at here.
And we also have some options. It's not going to be on the show today, but if you want to call Brokers Alliance, and we'll give you the ones that are on marijuana now, medical marijuana.
Right.
I mean, now we're saying, wow, the doobies have made it into the grid.
Exactly.
Wow.
Absolutely.
Wow.
And even though we're in term conversation right now, I just wanted to point out too that John Hancock also has an incentive to quit smoking plan on their permanent product line. So if you have a plan to quit smoking over the next 3 years, we can illustrate that at non-smoker rates. And then, as long as you really stop smoking, then you'll continue with those non-smoker rates
36
after that.
months from now, you're going to get a coatine exam on your urine analysis, and I hope you've taken the opportunity to go 36 months and become a non-smoker.
Exactly. I have a choice. Do you either want to go ahead and pay higher premiums or give up the cigarettes? You make the call.
I want to pay less.
Yeah, there you go. So getting back into term, 10-year term, we have Prudential at the top at $1,245 annual premium. John Hancock is $1,310. Jumping into the 15-year, we have John Hancock now on top, which is at $1,450.
Shocker.
And then Prudential, just $25 more a year for that. 20-year term, Prudential on top at $1,775. They are extremely competitive in this scenario. John Hancock is at $2,020. Now, jumping in, I'm going to skip to the 30-year term, Prudential on top, $2,535, and then Transamerica does show up as second best, but quite significantly higher. So we're looking at $5,540.
Remember, this is all in our term report. We can't go through this whole thing because time constraints are just so much, and I want to head into a little bit of GUL land. But this report, you can hop out, www.brokersalliance.com/March Madness. Go ahead and just register the report. It's absolutely free. It's 73 something pages, but I thought you'd want to know. We've tried to do a complete, across the board, every health category that is non-rated, and I think you're going to really enjoy it. Jesse, talk to me a little bit about, because some people call GUL permanent term. Okay, I mean, because there's really, most of them don't have cash value. Right. There's going to be some exceptions, and I'll point them out. But give us some numbers on our GUL grid.
For GUL, we're looking at Genworth at the top. Again, we're looking at comparisons, $1 million. We're looking at age 45, and right now I'm giving you an example for male. And for that premium, we're looking at $5,653. Prudential and John Hancock come in after that. American General, they're all really neck and neck when we're looking at that option.
And just remember, most GUL contracts do not have any kind of endowment cash value, but there's a couple exceptions to this rule, and heads up, LGA Banner is one of them, and American General are another. So if you're going to have to sell GUL, you may look at that, because even though the cash endowments to age 120, half of that's about age 100, and quarter of that cash is still at your actual life expectancy. So it's worth looking at some of these, just because even though they're GUL, they have cash.
Right. There's some additional benefit there in a lot of situations.
You know, I'm looking at, a lot of people are trying to do, because there's no money in money markets today, people are looking at single deposit GUL.
Right.
Who are the players in that? Because I'm just kind of, I kind of know, but I want people to understand this is where you should put your money, because we're not making any interest on the banks right now, so this is the way to go.
Right, absolutely. Looking at female, we're looking at age 65. You know, that's usually when we're kind of looking at that scenario. And $1 million, we're looking at Aviva. We're also looking at North American. And North American has also been a phenomenal carrier for us. As far as service, compensation, you name it, they're right up there. Looking at males, what we're seeing here, North American on top, Aviva, Protective Life, Prudential, all options that we want to take a look at for you.
Now, what about second to die, or I'm sorry, we just did single GUL. What about second to die single? Because this is also becoming an issue. Remember, the unified credit's still at $5 million apiece.
Right.
This could be a great time to really leverage single premium second to die, because the leverage on 2 lives is just huge.
Absolutely. Taking a look at your survivorship options here, again, looking at birth date, age $55 million, and at, it looks like principal comes up top. When we're looking at single premium, maximizing that death benefit for the amount of money that they're putting into it. Prudential, Aviva, United of Omaha, MetLife.
Wow, United of Omaha, that surprises me.
Absolutely.
Wow. Way to go. Way to go, Wild Kingdom. and what about, you know, we're always wanting to touch a little bit on par whole life. Who's the indemnification players, the death benefit players?
Looking at that, we're looking at our top 5 here. Number 1 is going to be Met. They stand out, and again, we're looking at $250,000, and this is for male non-smoker example. After them, we're looking at Nationwide, New York Life, and Assurity, all of which are available here at Brokers Alliance.
By the way, just a heads up, normally I wouldn't bring this up, but when we're talking about income scenarios, and everybody, the dominant market is still going indexing, a little bit in VUL, but most of it's indexing, I've noticed that because of the dividend raise, the actual increase in dividends, Mass Mutual now has become, it's kind of an inserted player.
Right.
Par Whole Life is starting to become something to look at the lower indexed UL proposals. And just keep in mind, Mass Mutual's numbers here are really very, very competitive. So I'm really looking to see how to really measure that up with Par Whole Life, current assumption UL, which is both of those are interest rate driven, against indexing. And sometime in September, we'll do kind of a VUL. We're not going to do any FINRA today on VUL. But let's talk about that, because those income scenarios are going to be huge, and we're looking at some of the top players. It still is Allianz, Nicola, Life of the Southwest. I mean, there's some very big players. Lincoln Financial, all in the indexed income scenarios. These are all things that you can order for us, because we really want to try to keep you up to date on the grids. We try to at least change it out every quarter. Sometimes we have to change it out every month. But I want you to be aware of that. And remember, you can get the entire term report. Just go out to our website, www.brokersalliance.com/March Madness. Now, you know, we're going to have to close our segment up here, because we got to touch on so much today. Jesse, when I look at some of the second to die, because that is a play for annual premium, who are my players in that?
Looking at second to die, and we're looking at, we did cover single premium. If we're looking at annual premium here, we're looking at MetLife, Aviva, Prudential, Principal and Lincoln. Lincoln has been a phenomenal player as well for underwriting. I just wanted to point that out there. We've had some deals that didn't look like they had any hope of getting approved anywhere, and they were able to close that deal for us.
Yeah, I just want to remind everyone, it's really critical. A lot of people win the grids on the numbers, but who can underwrite? And right now, Lincoln's been a very big player in substandard and regular underwriting. So we definitely want to be able to pay attention to that. Those are the kind of things we're talking about. This has all been our March Madness tribute to the life section. Again, you can go out to report and order at www.brokersalliance.com/March Madness. Hey, you're watching the Final Four Insurance Product Review, our annual tribute to March Madness, sponsored by Legal & General America, your company for life. You can download the 2012 Term Insurance Product Report at www.brokersalliance.com/March Madness.
Banner Life Insurance Company and its subsidiary, William Penn Life Insurance Company of New York, comprise the Legal & General America companies, part of the International Legal & General Group, one of the largest insurance companies in the world. Now, Legal & General America is one of the top-rated insurance companies in America, with one of the strongest financial balance sheet among its peers. Legal & General America is a major player in guaranteed term and guaranteed universal life, and consistently ranks among the best carriers in almost every product spreadsheet. Legal & General America's product line of guaranteed universal life endows at the maturity date, while most carriers' cash values just zero out. You know the reputation of Banner? Now know the value of LGA, Legal & General America. The power to protect, the power to preserve, the power to serve their policyholders. That's Legal & General America.
Well, welcome everyone to our Bravo special event, the Final Four Insurance Product Review, our annual tribute to March Madness, sponsored by Legal & General America. Well, with me, we're talking about one of the next generation's brightest minds when it comes to annuities. He's been on my show, the Business Insurance Zone, several times. Please welcome Eric Palmer. Eric, welcome to the show. I have to say, Eric, we have a lineup for the Final Four on this. We are all over the board, and I see there's a couple surprises to me.
Oh, yeah.
Some new players, too?
Definitely. And when looking at annuities, it's a little bit different than the segment we did on life insurance. We can't even necessarily go down from top to bottom. There's a lot of nuances to these annuity products that kind of made me choose them to be part of the Final Four picks. So we're going to change things up a little bit. But these grids, again, as we've mentioned before, they're available through our annuity department, which is extension 125. You call into Brokers Alliance. We'll run these grids in any way that you'd like to see them.
Well, let's go through the indexing first. And let's do it by bonus rates. Now, people, we've had to make our own grids on this, just because we feel like the mass global approach to annuities is not good enough, especially because you said of the contractual annuity, not annuities, the contractual imperatives. Right. All those things are different. So let's talk about index by bonus.
Well, I'm going to break down premium bonus kind of from my first pick to my fourth. And number one for me would be a new product that just came out from Oxford Life. Oxford has a 10-year surrender contract with a 10% premium bonus. And the premium bonus is added up front, not only to the accumulation value on the annuity, but also to the income rider's value that we'll talk about here a little bit later on. But again, it's the only 10-year contract with a 10% premium bonus in the country. Coming in number two now would be Equitrust Life. Now, they've got a 12% premium bonus. Again, I choose them second to the Oxford contract only because their product is a 14-year surrender. So Oxford coming in at number one, 10% bonus, 10-year contract. Equitrust coming in number two with the 12% premium bonus. Number three in the lineup here would be North American, and we choose them not just because of the 10% premium bonus that they have on their contract. It's a 14-year surrender with their Charter Series product, but also they're A+ rated. So when you're looking for a carrier that has one of the higher ratings in the country, North American is definitely one of them, and with a 10% premium bonus on a 14-year product, it's a good fit for a lot of clients.
Wow.
Number four would be American Equity, and we've known this product. We've seen this product for a lot of years now. It's the Bonus Gold. It has a 10% premium bonus as well on a 16-year chassis. So again, you can kind of see the order I went in there. All top premium bonus products in the country, starting from 10 to 12%, and I kind of broke them down again by surrender schedule.
Is it my imagination, or has the 10% bonus carriers giving that out kind of shrunk a little bit?
Well, that's a great point. Actually, it's nearly gone away completely.
Right.
These literally are some of the only companies that we have that have a 10% premium bonus. And at the end of the day, what's most important is to remember that The reason these are changing is because of the low interest rate environment, and also the NAIC changed the rules a little bit. The carriers have to build these products on 10-year surrenders in a lot of the states now, so they can't afford to give out the premium bonuses, which makes our list narrow.
Wow. Well, let's go to index by annual point-to-point caps, which is going to be a little debatable, but I'm not going to do it in this show. Let's just do index annual point-to-point caps and tell me who the players are.
If you're talking to consumers out there that are looking for pure rate, they want to see an index annuity, they like the downside risk protection, but they actually are really interested in the top caps or the top opportunity for growth, then we've got a few carriers to mention here. And number one would probably be Athene Annuity. Now, for a lot of you that don't know Athene, they're the ones that bought Liberty Life, who was sold by RBC. So last year and the year before, we were familiar with selling RBC products. It's now Athene. And very good company. They have a very good growth model, and their caps right now are phenomenal. They have a product called the Choice 10. It's a 10-year surrender schedule, paying a 5.5% cap on an annual point-to-point on the S&P. So again, 5.5%.
Wow.
A couple of years ago, we weren't saying that was very good, but in this rate environment, that's the best we've got.
Honestly, what are the average? I mean, it's like a point or 2 points down.
Oh, it's anywhere from 2 to 3 points down, and what's incredible is that the drop happened really rapid. So we're kind of hovering in these lower rates now, but again, 5.5% in the market today, that's a pretty good deal.
That's a screaming number.
Now, Athene also has an 8-year product. It's the Enhanced Choice 8. And I bring them up because on a shorter surrender schedule, we're getting a 5.75% annual cap on an S&P annual point-to-point. So again, a very strong cap in relative to what's out there today, but an 8-year surrender. So clients that are looking to maybe go from a variable contract to a fixed, they want to see the same type of surrender schedule makeup, that would be a great product. Coming in very close to them is, of course, Fidelity and Guarantee, F&G. We used to know them as Old Mutual. But F&G is a company that has some great products out there. They have a product called the Accumulator Plus. It's a 14-year surrender schedule, 5.5% on the annual point-to-point as well. So you kind of see the trend here, the top caps relative to about 5.5%, 6% range.
Wow. Well, I'm looking at, when I think about that, that's a industry-leading rate. 5.5 point-to-point, I'm into it. What about index by income rider? And boy, I wish I could spend some more time on this, because this is where the market is absolutely going. If you're not doing indexed annuities using income riders, well, who are the players?
Well, there's a lot of products to choose from in this category. And again, I kind of broke it down based on not just who's paying the highest payouts all in, but also some of the other features that we're starting to see on income riders. Because remember, we don't want to commoditize the income rider. We don't want to create a situation where we're selling companies strictly on the fact that they're paying out maybe a few extra dollars than the others. There's some additional benefits in these products that we want to point out. My number one pick would be Forethoughts Bonus Advantage. Now, they don't have the highest compounded rate. They're at 6% compounded, but what they'll do is they'll let it compound for anywhere between 10 and 20 years based on the age of the client when they purchase the contract. They also allow it to grow up to 250%, and that income account value is also the death benefit value. So if your client passes away anywhere along the line here in this accumulation or after taking the income, they potentially have a higher income base to pass on to the beneficiary, which I think is a huge
now,
feature.
Are all the 4 players that you're going to mention, are they all playing that?
Not at all. In fact, they're one of the few out in the country that are actually providing a death benefit feature relative or related to the income rider. So it's a very short list, and they're at the very top of it in terms of death benefit and income all in on the same rider. Coming into my second pick here would be Great American. A-rated company, very strong. We all know them well. They have a 10% simple interest on their income, and they pay really well in the older ages. So when we're looking to maximize income, but also have some additional benefits tied to the death benefit portion, Great American's real close there. They're coming in at number 2. Number 3 for me would be Oxford Life. I mentioned their product at the beginning. It's a 10% premium bonus, but for only a 50 basis point charge, which is one of the lowest in the country, they're giving an 8% compounded interest rate. Their payout factors are very much competitive in the market, and they're right up towards the top in terms of overall payout, and they have a good 10-year contract to put the rider on.
On the previous 2, what is the cost then for the income rider for the other 2 then?
Between 75 and 95 basis points.
Would you say that 50 has got to be the lowest of all these buy downs?
Other than the last one I'm going to mention, it's absolutely the lowest. The average in the country right now is about 95 basis points.
Wow. That's low.
Phoenix Life also comes in closer. They have a 14% simple interest. They're better for a long-term growth. But there's a product I got to bring to the forefront here, and it's going to be Oxford Life again. They have a 5-year multi-year guarantee annuity. So a short 5-year MIGA with a guaranteed interest rate. but with their income rider, it's free. There's no cost to it, and it's always going to guarantee the client it's going to have at least a 5-point spread over the current rate in terms of compounded growth for the income side. So if your client wants to just walk away in 5 years, they get a guaranteed rate. But if they want to stick around, turn it into income, right now current compounding rate's at 8% on the income rider, and it's free. So
no cost at all for
no
that?
cost at all for that rider.
Wow.
I think it's a unique product. It's something to look at when we're doing the income riders.
I know that there's so many features, and I wish we had time to go into it because it really matters when you look at some of the actual contractual imperatives. So we're just talking about the top 4 based on these areas of bonus, annual point-to-point, and income rider. I'm wondering, because we're going to shift gears, to MYGA and what the rates are on that. But I'm looking at it. These products are so hot right now, and we have studied the indexed market. We have one of the top consultants, she's been on our show so many times, Cheryl Moore, just keeping us apprised of everything that's going on in the indexed annuity area.
Right.
Well, let's shift a little gear here, put the clutch in, and let's go to MYGA and talk about it.
Well, we're selling a lot of multi-year guarantee annuities, fixed annuities right now, because at the end of the day, what it boils down to is marketing edge. We talk about it all the time. Every month we do a monthly update, and I start with these rates because when you're out there marketing to consumers, you got to ring a bell somewhere. And when we're getting money market rates below 30 basis points, when we're getting Treasury on the 10-year below or in and around 2%, there's not a whole lot of options out there for fixed rates that are guaranteed. So I picked 4, or my top 4 on the multi-year guarantee. The first one I want to bring out is a product I just mentioned before. So it's the Oxford multi-year guarantee. It's called the Income Protector. And what makes this product so unique is that currently it's paying 3% for 5 years, so one of the highest 5-year rates that we're going to find in the market today. But they have that free income rider that provides currently the 5-point spread, as I mentioned before, currently paying 8% compound.
Can I make sure we understand this, just because I think we had a little time just to mention it. If I do a 5-year hold on this, I have the option then of taking my money and running at 3% at 5, or I can stay in for this free income rider because it doesn't cost me.
Right, free income rider, and it's paying 8%.
Wow.
And what's unique is in certain age classes, let's take a 60-year-old, if I take that 5-year MYGA with no premium bonus, paying 3%, and I have the 8% compounded on the income side, and I take a 10-year product with a 10% premium bonus and an 8% compound, in 5 years, I've got the same payout. So why not offer your clients a walk-away vehicle that also turns into income, so they have the options. It's just another part of a planning tool. Or if you're doing annuity laddering, this is a product you have to be using.
This is a pivoting product. You have to think about it. Pivoting product, something like this, is really unique. And I want the flexibility to be able to call an audible at the end of that 5th year. Good call. What's number 2?
My number 2 pick is going to be the pure top rate company, and they've been leading this for quite some time. Sentinel Security Life, good little company. They've come out with some annuities here recently, and they're ruling the rate spectrum, and it's a pure deferred rate. So we're not talking about a whole lot of fancy features in the annuity. It's just they have their 5, their 10, or their 7-year product. The 5 year's paying 3.2%. Okay, the 7 year's paying 3.3%. And the 10 years paying 3.6%. So they're leading the category in those 5-year terms, and 7-year terms and 10-year terms. And again, a strong company, pure rate, good commissions. It's definitely one if you're competing against CDs or other alternatives.
Wow, and that may not be a name that our people are really. Most producers say, "Gee, I've never heard of Sentinel," but really they're becoming more and more popular. They're on the street. They're heading out to the blogosphere. I mean, we're seeing them more and more.
Absolutely, and again, these are companies that are the first 2 that I mentioned. They're rated B++. So they're very strong companies, and we're seeing the top rates right now coming out of B++ rated carriers. So and this is why, leading into my 3rd pick, if you're looking for a company and you have to be in the A-rated range, A+ North American, they've always been very, very consistent in the multi-year guarantee market. Right now they're paying 3.15 on a 10-year, they're paying 2.55 on the 7-year, and they're paying 2% on the 5-year. So not as competitive in terms of rate when you're looking at the first 2 picks I made, but A+ rated company, they're always consistent. So if you get into a cycle selling companies, you count on North American typically being around and still beating the banks and beating the alternatives. So even on the lower spectrum of annuity rates, you've got the deferred commission or deferred interest or tax deferred interest that's truly compounding. It's beating the alternatives.
Number 4.
My 4th pick, Liberty Bankers Life. They're always ruling the 7-year and the 5 years in payouts. Not necessarily in terms of carrier rating, but definitely in terms of product rate. Their 5 years paying 3%, and their 7 years paying 3.3%.
Well, I'm thinking if I'm 3% at 5, that's a really huge lockdown for not that long. I can't believe I'm saying 5 years is not that long.
Right.
But 5-year lockdown at 3%, when you think about it compared to not only all the banks, even the best on bankrate.com. I mean, we've seen these numbers. These are major players. If people are in a hold position, they can stay put for 60 months. I mean, 3%. Wow.
And we've got marketing pieces on all this stuff. So if you want to put an ad in your newspaper, you want to go out to the internet, to what have you, contact Brokers Alliance, talk to your annuity representative. We'll make sure we get you some of these advertisements, because the 5-year CD is at 1.5%. You can show them a 5-year annuity at 3%. It's a win-win all day long, and it's a very easy sale to make. And of course, that opens the door to start talking about other things like managing money, life insurance, long-term care, as we'll get to in the next segment. So there's a lot to talk about. You can open the door with rates like this.
When I think about the show we just did that's on the air, and you can go out to our site, www.brokersalliance.com, hit our on-demand video section, that whole combination annuity show, 5 days with Ken Davis, that was huge. And we know that a lot of our producers not only saw the show, but now they're implementing the modeling based on some of the very contracts we're talking about today for this new idea of income. Using strategies and laddering of annuities.
Absolutely, and if you didn't catch the show, we're calling it the modern version of the combo annuity. We're changing things from the old school way of doing it, and you have to do that when the interest rate environment is like it is today. All the economists are predicting sort of a slow, steady growth, at least for the next 4 to 5 years. These combo strategies are really powerful, and again, another thing that you can market to get more people to talk to, more prospects to introduce these concepts.
Now, we're not doing the old combo. We're doing now the new modernized combination annuity. It's huge. You can call Eric at our number and extension 125. You're watching the Final Four product review, our annual tribute to March Madness, sponsored by Legal & General America, the company for life. You can download the 2012 Term Life Insurance Report at www.brokersalliance.com/March Madness.
Banner Life Insurance Company and its subsidiary, William Penn Life Insurance Company of New York, comprise the Legal & General America companies, part of the International Legal & General Group, one of the largest insurance companies in the world. Now, Legal & General America is one of the top-rated insurance companies in America, with one of the strongest financial balance sheet among its peers. Legal & General America is a major player in guaranteed term and guaranteed universal life, and consistently ranks among the best carriers in almost every product spreadsheet. Legal & General America's product line of guaranteed universal life endows at the maturity date, while most carriers' cash values just zero out. You know the reputation of Banner? Now know the value of LGA, Legal & General America. The power to protect, the power to preserve, the power to serve their policyholders. That's Legal & General America.
Well, welcome everyone to our Bravo special broadcast event, the Final Four Insurance Product Review, our annual tribute to March Madness, sponsored by Legal & General America. Well, with me today, I like to call her the Mensa of all that is morbidity, the lady of long-term care herself, Susan Carlson. Susan, I'm looking at long-term care. It's a player. We have to talk about it. If it wasn't a player, how come all these products are doing linked products, right? So let's talk about a couple linked products before you get to your Final Four standalone LTC. And I'm talking about State Life, or One America for all of us who are in the bigger picture. They have a product that has a linked annuity to it that really, when you're looking at annuity and LTC linked products, that is a top player.
Absolutely.
So talk a little bit about that product, then we'll go on to the next one.
The linked benefits annuity and long-term care is actually a very nice alternative to a client that might not be open to traditional long-term care insurance for whatever reason. And how these annuities work is they are based on an annuity, and should the individual need long-term care, they can then take withdrawals from the annuity, and the bonus is that those withdrawals are tax-free. So if I have an existing deferred non-qualified annuity and I 1035 it into one of these State Life products with gain, and this product pays out for long-term care, I'm never taxed on the gain.
So now that contract, if I remember correctly, is indemnification. Is that correct?
Absolutely. Well, you have two choices.
Well,
you can do indemnity, you can do reimbursement. They actually have a portfolio depending on your client or where the money is coming from as to which one of their annuities would be the best fit.
Well, that definitely is a player. We've been using it, talking about it. There are some major, and I'm talking major competitors that we compete against that are using this as well, because it is a great product. So if you see 2 or 3 of these IMOs, independent marketing organizations like ourselves, selling it, you know it's hot. And I just want to touch on one other thing. The 1035 of gain that you mentioned, that is a huge issue, because now I can take that money, as long as it's for LTC indemnification purposes. I can't just go ahead and take it out for my own income. Correct. But if I use it for LTC, it's free. Thank you for the Pension Protection Act of 2006.
Absolutely.
Talk a little bit about, and this product has been around forever. It's probably the first linked benefit in brokerage, and it is Lincoln National's MoneyGuard. It's life insurance with an LTC rider.
Absolutely, and we're seeing these products becoming more and more popular. Again, because clients are trying to get over some of the objections, what if I never use it? And these linked benefit life products are fabulous, because it's a win-win for their client. If they never need long-term care, then the product pays a death benefit. If they do need long-term care, then it pays out a long-term care benefit. And the beauty of the MoneyGuard is it's absolutely guaranteed. And in today's times, that actually works very well with the clients. And the fact that I can get my money back anytime that I'd like. So I can actually sit down with my client, talk about repositioning some assets from their existing CDs, or maybe they have an old life insurance product, moving them into a MoneyGuard, and then letting them know every year we're going to sit down and review this to make sure it's still a fit, and if it's not, we can get all your money back.
So even if I had buyer's remorse 36 months out?
Absolutely.
Wow, that's a huge provision in the contract, and I want you to heads up. This is a way to get in. Talk about no obligation. This is a front end buyer's remorse. Hey, if you don't want out, if you want out, you can get out. I love the exit strategy on this.
Absolutely.
Well, let's get into the main body of what we're going to talk about today. Now, is the market, first of all, I just am curious, the market's really going someplace on long-term care standalone policies. Now, we're not talking about linked like we did the last 2 products. We're talking about your top 4 picks. And let me tell you, if Susan Carlson's saying these are the top 4 picks, these are the top 4 picks. Let's talk about your number 1. If you had to sell this to your parents, right? Susan, who would it be?
Absolutely, hands down currently would be Genworth Financial. Genworth has the longest history in the long-term care industry. They also have the biggest block of business and really know how to position and how to handle a claim. Also with Genworth, it happens to be right now, they are the most competitive carrier for couples. Not that it was planned to be that way. However, with the other carriers and the way that they've repriced their products, not only is Genworth extremely competitive, they have the history behind them to make sure that the claim is processed appropriately.
Now, so, but bang for the buck, how is their premium? It's pretty good premium?
Absolutely, especially when you're looking at a 5% compound or doing any type of inflation, maybe a longer benefit period, and also for younger individuals. Genworth right now owns the market.
Wow, that's a heavy thing to say, because I mean, usually not one carrier is going to own anything, but Genworth's a major league player, long-term care. We play with them big on the life side. We're just now adopting your approach on the long-term care side. So if you're looking into long-term care and you're looking at one of the top products in the nation, according to Susan, maybe the best product in the nation, you may want to look at Genworth. Who's number 2?
I would have to say the Omahas, whether it be Mutual of Omaha or United of Omaha.
Well, do they have 2 distinct contracts?
They do, but they are under the umbrella of United of Omaha, and very similar, and just some little different nuances that. So I'd like to compare them as
well,
one.
Let's talk about that.
Well, with the Omahas, they have a nice presence in the senior market, and they will provide a discount if that client happens to have a med sup with them, which actually makes the door, it actually opens the door to have that conversation a lot easier. They do have some key benefits on their home health care. They have different underwriting classes, and I think they probably have the best return of premium rider in the industry today.
Well, let's go back to your med sup. So if they have a med sup with one of the Omahas, is it United or Mutual or
Either
both?
one. Either one.
They would get some kind of a discount when they go ahead and buy their long-term care?
Absolutely.
Wow, well, is that discount pretty substantial? Because I know a lot of geriatric clients, our seniors, are buying med sup. That's kind of part and parcel for what you have to do when you get older. So are they, is the discount really that steep, or what's the combination?
It's a 5% discount.
Well, I'll take it.
But again, it's just a great door opener and a way to open that conversation.
Well, I think a lot of people, you know, we talked about when you're looking at things like ROP, return of premium. I think that's a huge issue. Is that return of premium rider costly?
It can be, and it is always paid upon death. However, there are different types of return of premiums where you could have one regardless of claim. So no matter what, when you pass away, this money that you paid into this policy would be passed on to your heirs income tax free. Another strong point to the Omahas is they have rate guarantees. So I could actually set up a 10-year premium pay, do a 10-year rate guarantee, and I have a non-can.
Wow, so that is extraordinary. And how far up the age group does that go? Do they offer that? That's the guarantee that high up? 75, 80 years of age?
Absolutely.
Wow, that to me is an anomaly. If I could combine my Med Sup, United or Mutual, I don't know which one we're talking about, but the Omahas could be a major play in the LTC just on the issue that most of us that are into 65 and higher, we're already buying Med Sup.
Correct.
I love that.
Correct.
Who's your number 4 pick?
My number 4 would be Transamerica, and I like Transamerica because of the several underwriting classes they have. They are also the only carrier left that has a single pay. So if I'm looking to doing some repositioning of assets, we can definitely look at the Transamerica product.
Well, let's talk about that for a little bit because we've been talking for the last 3 or 4 months on almost all the articles and blogs and tweets that I do that there's really, the interest rate market is so low. You're sitting there in money markets that are paying nothing. You're talking about CDs, even lockdown rates are pathetic, even for 5 years. So if I'm doing a single deposit into Transamerica, and I'm already going to think about, I'm going to have some long-term care, I already maybe have a family disposition for those kind of issues. I mean, this could be a major play, doing single premium. I'm done with it, right?
Yes.
It's completely done, no more future premiums. I'm locked into my contract, and I can pay this single deposit. Have you seen a lot of people going to this just because the rates are so low?
We haven't seen very many, but it does have a nice niche where I could do that perhaps maybe in a business type of scenario. Do it as an alternative to a Section 162 or bonus plan, where the corp would actually pay the single premium, put a return of premium, so that way if the executive never needs the policy, then that premium or that bonus is then passed on to the heirs.
ROP, you can ROP the single premium?
Absolutely.
Well, that's a huge issue. I think that's extraordinary because if I can go ahead and I can return it, if I don't use anything and I just need it later on, right? I mean, is at death or a certain time?
It's always at death. Yes.
So if I don't use it, my heirs at least don't lose it.
Right.
Okay. Well, that's fair enough. Well, let's talk about. I want to try to now. We've talked about the combination. What I want to see is we know who the players are.
Okay.
When would I use an annuity LTC versus like one of these standalones? Or when would I use MoneyGuard, their life LTC, linked to LTC, compared to these 4? Because some people say, I want to have the link benefits, and the reason I want to have the link benefits is because if I don't use it, I won't lose it. But if I have ROP on these others, at least my beneficiaries aren't going to lose it. So give me a kind of a yin and a yang. We're protecting our client if he doesn't use it.
Okay.
So which one is the strength?
Well, to me, it really depends on the financial portfolio of the client. If the client has existing deferred annuities, which they don't plan on using in retirement, it would be nice to take maybe 1 or 2 of those and reposition them and get a better leverage if they need long-term care. With the life insurance, that has a much higher leverage for the premium. So someone that might be open to life insurance, and it's really more around to overcome the objections. I don't want to pay this forever. What if I never use it? But to me, the ideal situation is to use both of them hand in hand. So I have an existing life insurance policy, move that into a MoneyGuard, and then sell a small standalone long-term care policy either to make up the gap or to be your inflation protection.
Well, I'm thinking about that. It's an excellent idea that you could actually use 2 of these. You could use an LTC annuity, like One America State Life, in tandem with one of your standalones, right?
You bet.
Now, and I noticed that in One America, I'm wondering because One America, that has a very long benefit period. If you want to really buy that longer benefit, that's pretty good. When do I know, should I go to a One America? If I'm looking strictly at the benefit issue,
Okay.
that's about, I think the one I saw was like 11 years. It was quite long. So when do I want to trade an 11-year annuity LTC like One America's State Life's annuity care, and I want to trade up? No, I need to go longer. When is it on that demarcation line of 11 years when I go standalone, or can I do some kind of potpourri or concert, buying this in tandem together?
Well, with State Life, they do have an annuity that you can get a lifetime benefit. So, it is part of their portfolio.
So if I do a lifetime benefit on their LTC annuity, is that better bang for the buck than a standalone, one of your top picks like Genworth?
I don't know. No, to me, the best leverage will always be, hands down, a traditional long-term care policy. But if we need to pivot and look at other alternatives, that's when I would fall back on the hybrids.
I want to drop to your top 4 again now.
Okay.
When I'm looking at Genworth,
Yes.
I'm looking at the as you call them, the Omahas, and I'm looking at Transamerica. I want to know that since they have a little anomalies. When I'm looking at the normal American in their 60s,
Okay.
pretty healthy. I don't mean perfect, but basically standard on a mortality table, and they don't have really any disability issues or any morbidity issues. Why does when do I know which one to pick? If you're sitting there, I know Genworth is your number 1 pick, but there are reasons why you pick these others. Is there any one reason that sticks out in your thumb where, oh, I wouldn't go to Genworth because I'd look at these other 3?
It would have to do with underwriting and different medical history. That's, Genworth has got some pretty definitions, clear definitions on what they will accept and what they don't take. So that would be one of the times that I might not look at Genworth, or it could just be the situation where I need rate guarantees or something, a single pay, then I would fall to my other carriers.
Well, I think that's a big important issue because underwriting morbidity, oh my goodness. We're talking about, you think life insurance is hard to underwrite. Long-term care, when I'm looking at that. So if Genworth is a little conservative, which is what I'm picking up from you, if the client's really in great health, Genworth hands down. But if I have issues, underwriting issues, substandard issues, I need to start looking at that. That's what you're telling me.
Absolutely.
And the last thing is I kind of like this single premium because, like I said, because people are looking, I get ROP on both the Omahas and the Trans, and Genworth as well.
Yes, but it's not nearly.
It's not as
I don't think it's as strong.
So if I had underwriting issues, I'm looking at those other 3 that are a little more benevolent.
Okay.
And I have ROP on that at death, so at least my beneficiaries are going to get that back, right?
Correct.
I love that. Well, I think sometimes when we were talking about combination annuities on our show a couple weeks back, I'm thinking about doing your idea called combination LTC using annuity LTC linked or maybe even life LTC linked with a major product. Remember, you can contact Susan. Her extension is 147 at 1-800-290-7226. If you want to understand the top 4 contracts in LTC, the definitions are huge. She understands the contracts, the imperatives, and can illustrate any of these contracts. It doesn't matter which one you're looking for. We're just kind of displaying the best of the best because that's what the Final Four is all about.
Absolutely.
Trying to actually put inside the trophy case the best of LTC. Well, you've been watching the Final Four Insurance Product Review, our annual tribute to March Madness, sponsored by Legal & General America, your company for life. And you can download our 2012 Term Life Insurance Report at www.brokersalliance.com/March Madness.
You've been watching the Final Four Insurance Product in Review, sponsored by Legal & General America, Banner, William Penn, your company for life. This has been a Bravo special video event from the media division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance. Download the 2012 Term Life Insurance Report at www.brokersalliance.com/March Madness.